Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
The title of this video is Why Wall Street is Snapping Up Family Homes. This is from an article we got from The Economist that just came out. It's all data that's actual data that's out there, and it includes the numbers from Wall Street. So we're going to go through all the slides and talk about all this, but it's very fascinating. It is I hate to use this term, but I'm going to use it. It is a change in the paradigm of real estate because we didn't have this 10, 20, 30 years ago. As a matter of fact, a decade ago, this was an experiment. You know, $1 billion. Let's buy $1 billion worth of houses. And now this number is 40, 50 times that.
Right. So, about a dozen years ago, this investor that I don't know if you've heard of him. What's his name? Oh, I remember, Warren Buffett.
Yeah.
He talked about that if he could just write a check and buy 200,000 single-family homes, he would. Well, that's basically what's happened since. He said that is there has been exactly that. There have been all these institutional investors snapping up as many single-family homes as they could because they have figured out that this is a good long-term investment. And it's not just institutional investors. Look, I have listings and I still get offers all the time from investors having anywhere from $750,000 to $14 million to invest. And I get bank statements. I do get proof of funds from these people, and I see that. So the investors are out there, and there's a wide range of investors, not just institutional investors. So there is this still concerted effort to acquire single-family residences as investments.
One of the quotes from the article, according to John Burns Real Estate Consulting, a research firm, big investors committed at least $45 billion to buying single-family homes in America, up from $3 billion the year before. Now, this is not open-door flipping houses. These are buy and hold, and these are long-term. They're going to hold these homes forever.
Right.
So, let's talk about this first. How does this affect the housing market when we already have a low number of housing stock per the number of actual people, which is what has been driving up real estate the last couple of years? And then we get Wall Street in here buying up more of these houses, locking people up, making the effective houses you can transact a smaller number.
Right. So supply and demand. You still have individuals who would like to purchase their home, would like to own the home that they live in. So now they're going to have less inventory from which to choose, and they will be competing with each other and with investors for the same homes.
So Blackstone was the first one. They started buying homes. I think it was in Tampa, Phoenix, and Vegas back in about 2011, 2012. They weren't buying them through the MLS. They were going to the trustee sale. They were buying them through the trustee sale. They were the first ones to do this. They built a pretty substantial portfolio. Since that, this was just $1 billion investment back then, but homes were cheaper back then. Another quote from the article, even as housing markets cool, investment is pouring in with firms including Goldman Sachs and KKR following in Blackstone's footsteps.
Right.
So this means that, we could potentially be on the verge of more institutional money coming in, buying even more houses, making it even harder in the future. And when you have an investor who buys a house, like a institutional investor, and they're going to hold it for 30 or 40 years, that substantially changes the makeup of what transacting real estate looks like for not only agents and lenders, but for all the people trying to buy.
Right. It does change things. And so, what we're looking at is at some point we're going to get to this tipping point where maybe a majority of the single family homes will not be owned by owner occupants.
Right. Certainly they already predict that we're going to come to a point where most of the rentals potentially in the country won't be mom and pop that have a rental. They own the next house next door that they rent out. It'll be Because remember, this is a relatively new thing, and there's a lot of homes in the United States.
Right.
And there's a lot of owner-occupied homes. But the interesting thing is, if the owner-occupied homes aren't going to want to sell, they're going to want to keep it used as a rental too if these things get super expensive and if rents keep going up.
Which again is going to diminish the amount of homes available for other owner-occupants. The other thing is that with these investors holding these properties long-term, I think it's going to be interesting to see the cottage industry that's going to absolutely explode around refurbishing these properties, because homes get older, homes get outdated, and tenants prefer homes that are more updated. And we see that all the time, right? When we're looking at rentals, particularly in the apartment market, where the apartment complex will go through this whole big refurbishment and they'll redo the units and that sort of thing. So are these, particularly the large investors, will they do the same thing with the homes? Will they do more than just paint? Will they update them in other ways as time goes by?
I don't have the quote, but in the article it said that they're spending about $35,000 per property to get everything fixed up, which tells me that they're keeping the property long term. Meaning they're going through, they're not just doing paint and carpet. They're redoing kitchens, fixtures. They're making these things so that when they're done being rented, they can just rent them to the next person. That they don't want to deal with the house sitting around. They want to build. They have cash. They want a higher return on their money, and they figured out the way to get it is with rental properties. Here's a quote from the article that puts this in more perspective. And this is why this is an exploding thing, these institutional investors. Between 2016 and 2021, annual returns from family rentals, 21% returns. Have outperformed those of housing for old folk, 7%. Offices, 5%. Shopping malls, -1%, because that's a dying market. And even apartments, 12%, which is historically a great investment that predominantly, apartments are mostly owned by large corporations. Right? So the money from Wall Street's going to follow where it thinks it can make the most money. And as it transitions out of office space and shopping malls, it's very clear where they need to put their money is the housing market. So when Juana and I talk about the real estate market and what we foresee happening in the future, we're not talking about 6 months from now and if prices are going to drop because interest rates went up. That's if you're investing in the stock market for what's going to happen in 6 months, you're going to lose, because you can't. It doesn't matter what happens in 6 months. What happens in 5 to 10 years is how you make your money in real estate.
Right.
And if Wall Street firms keep buying and buying and buying, you're going to get to a point where you're going to say, oh, I should have bought real estate like a bunch of years ago. Because remember, in 2018, we were told the real estate market was going to crash. It was overbought. 2019, we were told it was going to crash. 2020 was going to crash. 2021, we were told it was going to crash. We're told it's going to crash this year. And it started a slight decline. Everybody freaked out. But what happened? Wall Street, though, isn't freaking out. They're buying houses like crazy. So Juana, you have a bunch of listings. Let's just put this really in perspective. You actually have probably more listings right now than you've had in a while.
That's
right?
True.
Business has picked up a bit.
Yes.
Okay. Which is counterintuitive. A lot of people say, oh, you're doing terrible. Actually, we do better when the market declines. We've talked about this before. What percentage would you say of the offers coming in are for investors?
Most of them.
That is unusual, because we already determined that historically it's much less than a quarter.
Right, but remember, these investors are paying cash, and so they're looking for a place to park their money during a time of inflation and economic uncertainty. And they're also looking that this perceived downturn in the market, and it is a downturn, but I think the perception is far greater than the actual downturn in the market, and that's why I said perceived. That this downturn in the market is actually an opportunity, and it's an opportunity to get in and purchase these properties before the market pops back up again. As people will remember, if you knew then what you know now, we would have all bought every single house we could have possibly bought in 2009, 10, 11, because that was the bottom of the market.
And then refi them at 2.5%.
That's right. So, and that's kind of what these investors are seeing, is they're seeing this as an opportunity to purchase homes at a discount, not necessarily at a discount as far as the real value of the home, but a discount versus the frenzy that went on earlier in the year. They're not competing with multiple offers. And if they are, the other offers, are not necessarily that great. I mean, I am still getting multiple offers on properties, just so we're very clear on that.
Right. It hasn't completely stopped.
No, it hasn't stopped.
And agents are still asking, do you have an offer yet?
Right.
Yeah.
So I am still getting multiple offers on the properties. When we do have an accepted offer, I'm still getting calls saying, hey, can we be a backup on that? What can we do? Because people understand that this is an opportunity still. Yeah. The prices are softer. You can negotiate a little bit better. Interest rates are likely to go up before they come back down. So there are opportunities. So the investors are paying cash. People who are not paying cash understand that the interest rates will go up before they come down. So this is an opportunity for people. So people who understand the real estate market and understand an opportunity when they see it appreciate this and are still in the market looking to engage in transactions.
Another quote from the article, there's plenty of room for further expansion. In America, real estate investments trusts, REITs, own just 1% of single-family rentals. Mm-hmm. Those are REITs. We're only talking about REITs. We're not talking about all investors and not talking about institutional investors for sure. Compare with 5 to 10% of offices and warehouses, 15% of housing for old people, and 50% of shopping malls. So the REITs have that was their niche, right? Was to go out and invest in these stable assets that, malls especially, which are like the worst investment ever now because they're becoming functionally obsolescent, right? Malls, mm-hmm. that space needs to get reconverted to something else. But single family rentals, I think people are seeing this as a huge opportunity. And let's put this in perspective. Single family home prices, actually median in the US, only broke 400,000 in like April. Mm-hmm. And then I think they went up to 416. That's the peak. That's the highest they've been. In Toronto, it's 2 million. Toronto, 2 million. Most of Canada is well over 1 million. So if you're in Canada, if you're in Vancouver, it's super high. It's over 1 million in California. So when you're looking at an investment in something that's 5 times more expensive in Canada than the US, you'd rather buy a place in the US. And I think people still recognize this is a good investment. And really, here's the bottom line. It doesn't matter if you bought a house in 2002, 2006, 2012, 2015. It doesn't matter what one of those years you bought a house. Even if you bought the top of 2006, it's still worth way more. Mm-hmm. And you would think, oh, that's the worst time to buy a house. No, actually it wasn't the worst time to buy a house because you would have collected rent for 16 years. You would have probably made all your money back in rent. And now the house is worth 50% more than it was. So if you're keeping the house 10 to 15%, you're making money. Rents are going up. There's another good quote. If it's not in here, I'll tell you about it. But Wall Street recognizes this. Mm-hmm. And they're coming in, they're betting big bucks on this.
Right. And it's not just Wall Street, it's anybody who is looking for a tangible asset, right? Because I'm not dissing crypto, but, crypto is very volatile. And at the end of the day, it's not necessarily a tangible asset the way real estate is.
By 2030, MetLife Investment Management, an asset manager, expects institutions to have amassed 7.6 million homes. Mm-hmm. More than 2/5 of all family rentals. That means 40% of all rentals in the US. Where this is interesting is this is going to be probably 30 markets. Mm-hmm. They will completely dominate the rental market. Now, it won't be 40% across the whole US. There will be key areas like Phoenix, Vegas, parts of Florida, parts of Georgia, Texas, places like that. Probably not the Northeast, probably not a lot on the West Coast.
Right. So remember that they have criteria that they're looking at as far as which markets that they want to be involved in. And these tend to be markets that are growing markets where not only are they growing as far as people moving in, but they have other things going on as far as growing industry. They have a higher education as far as among the population because that generally means higher incomes and better yields as far as rent.
Here's a great quote from the article. declining housing affordability helps. It helps, and this is why those unable to buy homes have little choice but to rent, meaning landlords are confident of their ability to find and keep new tenants, especially for entry-level homes. Don't believe me? New York City. We'll talk about that in a second. In America, at least 420,000 starter homes were built each year in the 1970s. Last year, 93,000 starter homes. And remember, the population is much larger than it was in the 70s. Thus, rents continue to climb across the country. Those for family homes rose by more than 13% in June compared to a year prior. Okay, New York City.
Okay, talk to me.
Go find somebody in New York City that's lived there, and they'll tell you, I've lived here my whole life. I've lived here for 50 years. And say, do you own a house? No, they rent. They have thrown away their money to a landlord for the whole time. They have no equity. They don't have anything. It's very difficult to own in New York City because it's very expensive.
Right. So, New York is one of those kind of unique situations where you've got high property taxes, you've got income taxes. So there are all kinds of tax expenses that maybe you don't have in other places. Plus on top of that, of course, you have your mortgage, your interest, your insurance, and all that. So all of that put together does make it more expensive to own a home or an apartment in New York City than it does in other parts of the country.
One of the things that the Wall Street investors noticed was during the financial crisis when home prices fell 70, 80% in some markets. Rents didn't fall that much.
Right.
Rents fell 8%. So they took notice of that. They felt that rents were resilient. And even right now, we are not seeing... Have you seen any rent decline?
Very little. I mean, there have been some properties, but it's been very little. And to your point, Las Vegas, which certainly got beat up pretty bad during the Great Recession as far as real estate values, our rent prices didn't go down substantially during the Great Recession. Real estate prices, as far as home values, went down significantly, and we all know about that. But the rents didn't go down by very much. Certainly, nothing commensurate with the amount of loss in value as far as the value of the resale value of properties.
Median sale price in 2006 was $310, which today we laugh at because that was the peak, right? By 2011, it was $135. So that's a huge change. Median rent in 2006 was $1,200 a month. Median rent in 2011 was $1,100 a month. It only dropped $100. It's not even 10%. Okay, so rents are pretty resilient. People, rental homes don't sit on the market for 4 months.
No,
rental homes usually go pretty quickly. Especially with interest rates being high, this forces people into rentals. Wall Street has a ton of incentive to take over this asset class and control it and use it to profit because they've already found out that, look at what the S&P 500 and tech stocks have done. There have been some tech stocks that are down 90%.
Right. What's interesting to see out there is not just that rentals have been pretty consistent in the last couple months when everything else has definitely seen some price reductions. Rentals have not seen a whole lot of price reductions. And I think more significant than that, we're not seeing any offers of free rent or free anything. So the application fees are still in place. All of that are still in place. So it's still kind of the same type of market for rentals that we've become accustomed to. Renters still have to pay usually somewhere around $100 a person to apply. Those application fees are not refundable. So it gets pretty expensive. So if you end up applying for 5 properties, that's $500. That's gone. You're not getting that back. So maybe you don't get approved for some, or maybe you get approved for some, or maybe even all of them, but that's great. But you've just spent $500.
Just despite what's happening with interest rates, all it's doing is choking off owner occupants. Wall Street's going to keep buying. I don't know what prices are going to do in 6 months. I don't know what they're going to do in a year. But I would bet anything that 5 years from now, that home prices are more than they are today. And if you've bought a house in the last 5 years, you've 100% made money. If you bought it in the last 5 years, you've made money. And you've also made money in rent. And if you didn't buy a house, you haven't made any money in the housing market. You probably, if you just put your money in the stock market, you probably have lost money. It's a very profitable asset class because the home prices tend to appreciate, and you can collect rent. So you have two things growing you money at the same time. Whereas most stocks, you don't really if you have dividends, you probably don't have any growth. And if you do have dividends, it's probably like 0.5%. Like Apple's paying some little dividend, and you're hoping for future growth of the value of the company.
Right.
Whereas in some companies, remember, they get to be maturity and they stop growing. Whereas in real estate, it's driven by just scarcity. And if you looked at the long-term trend of real estate, it does very well. And I think Wall Street recognizes this. Our concern has always been people we represent, which are just people that are buying to live in a house or buying as investment property. And how is this an asset class that they're going to want to buy? And the other thing are these Gen Z people. They are the largest growing population of people. And they will not probably, there's a possibility they will not be able to afford housing despite being the highest earning population that's ever existed. They'll be the highest earning people, and they'll have an inordinate number of people renting because housing will likely become less and less and less affordable. Even though today, micro, looking at a very small, narrow window, it's a little painful because interest rates have gone up. And we did a market update video that showed that the market softened quite a bit.
Right. So long term, the issue is that there really are not enough houses for all the individuals that would like to purchase them. They are being taken up by people who are either individual investors who are purchasing them to rent out, or institutional investors that are doing the same thing. Over the long term, real estate does tend to appreciate. We have lots of people, and people need to live somewhere. And where they're going to live is going to be really interesting to see going forward. What concerns us is that we actually like to see owner occupants because we think that everybody should have their own home. And we see that that's going to be more and more difficult going forward as more of the market's being absorbed, particularly by large investors.
If you made it to the end of the video, thank you for watching. Please subscribe, hit the notification bell, share the video, and leave us a comment and tell us what you're seeing in your market.
Yeah.
The data we got is for the whole U.S., and there may be markets where institutional investors aren't buying. Certainly, they're buying in this market. We know because we see the offers. Even I think one came in today, right? One came in today.
Two. I had two.
Two came into different houses.
Yeah.
Different houses from institutional, like Wall Street firms. Okay. So leave us a comment.
Yeah. So in particular, if you're watching this and you're in Canada or you're in Australia or you're someplace a little more exotic than the continental U.S., definitely give us some feedback, because we're all very aware of what's happening here in the U.S., but it's always nice to know what's happening outside of the U.S., and it kind of gives us perspective too. So please, we encourage you to leave us comments. If you're in the U.S., leave us comments too, because every market's different, so we want to know what's happening in your neck of the woods.
All right. Please share the video, and we will see you on the next video.
Bye.
Bye.